Professional standards are established to measure the quality of performance of individuals and organizations. Standards relating to the accounting profession concern themselves with certified public accountant, or CPA, professional qualities, the judgment exercised by CPAs in the performance of their professional engagements, and a CPA firm's quality control. The purpose of this chapter is to make clear the nature of auditing standards, attestation standards, and quality control standards. In our discussion of the auditing standards, we will also consider in detail the nature of the independent auditor's report. As you flip through the slides in this PowerPoint presentation, you'll notice that on some of the slides I have voiced over the slide. Professional standards are established to measure the quality of performance of individuals and organizations. Standards relating to the accounting profession concern themselves with the certified public accountant, or CPA, the CPA's professional qualities, the judgment exercised by CPAs in the performance of their professional engagements, and a CPA firm's quality control. Our purpose in this chapter is to make clear the nature of auditing standards, attestation standards, and quality control standards. In our discussion of the auditing standards, we consider in detail the nature of the independent auditor's report. The regulatory environment for auditors and audit firms has become much more complex with the passage of the Sarbanes-Oxley Act of 2002. Previously, the American Institute of CPAs standards based on their general acceptance applied to audits of both public issuer companies or non-public non-issuer companies. The Sarbanes-Oxley Act created the Public Company Accounting Oversight Board, or the PCAOB, and charged that body with a responsibility for developing and enforcing professional standards for integrated audits of public companies. Integrated audits involve auditing both the company's financial statements and its internal control over financial reporting. The PCAOB also is charged with the responsibility of regulating the public company audit practices of registered CPA firms. The regulation of those registered CPA firms also includes the inspection by the PCAOB of those firms with a report issued to the Securities and Exchange Commission. The American Institute of Certified Public Accountants continues to set the audit standards for auditing non-public or non-issuer companies. The American Institute of CPAs also establishes the standards for attestation reports, quality control of public accounting firms, independence, ethical, accounting and review standards for engagements, again involving non-public companies. To complicate matters further, the state boards of accountancy have the authority to regulate CPAs and CPA firms that practice within their state or jurisdiction. CPAs who practice public accounting must be licensed by the states in which they practice and offer services to the public. You will notice in the footnote to this Figure 2.1 that initially the PCAOB adopted the AICPA professional audit standards as well as ethical standards that were issued through 2003 as their interim standards. The PCAOB has, subsequent to that, issued a number of their own standards, which would, of course, supersede any AICPA standards with regard to CPA firms that audit public companies. Over a period of time, the PCAOB will ultimately issue all of its own standards and will completely supersede all of the interim standards that they adopted in 2003. The AICPA has set forth the basic framework in the following 10 generally accepted auditing standards. These 10 generally accepted auditing standards have also been adopted by the PCAOB. The first 3 standards are referred to as general standards. The first general standard deals with training and proficiency. This requirement is usually interpreted to mean college or university education in accounting and auditing, participation in continuing education programs, and substantial public accounting experience. All 50 states now require a 150-hour accounting program to be qualified to sit for the CPA exam and become a certified public accountant. In addition, each of the states has their own requirements as to continuing professional education for licensed certified public accountants. Those requirements vary from state to state and vary in terms of their mandatory or voluntary nature. The state of Wisconsin, for example, happens to have a voluntary continuing professional education requirement. Therefore, in Wisconsin, to be licensed to practice public accounting, the CPA is not mandated to have any continuing professional education. However, membership in the Wisconsin Institute of CPAs, which is a professional organization, does have a mandatory continuing professional education requirement. The next general standard relates to independence and mental attitude. An opinion by an independent public accountant as to the fairness of a company's financial statements is of questionable value unless the accountant is truly independent. The AICPA, the PCAOB, and the Securities and Exchange Commission all have very specific and very rigid requirements in order for the CPA to establish independence. An example of independence would be that a CPA or a CPA firm that audits a company would have no interest in that company, no interest in the form of stock ownership, no interest in the form of loans or any contractual relationship other than a contractual relationship to perform audit and other permitted services by the CPA firm. The third general standard requires due professional care in the conduct of the audit and in the preparation of the audit report. This standard requires the auditors to plan and carry out every step of the audit engagement in an alert and diligent manner. Full compliance with this standard would rule out any negligent acts or material omissions by the auditors. Of course, auditors, as well as members of other professions, inevitably do make occasional errors in judgment. The 3 standards of field work relate to planning the audit, obtaining an understanding of the client and its environment, and obtaining sufficient appropriate audit evidence. Adequate planning is essential to a satisfactory audit. The auditor must obtain an understanding with the client as to the nature and scope of the audit. That understanding is set forth in a written audit engagement letter. Most of the field work of an audit is carried out by staff members with limited professional experience. The key to successful use of relatively new staff members is close supervision at every level. This concept extends from providing a specific written audit program to staff members all the way to review of the work by the partner in charge of the audit engagement. The auditor's understanding of the client and its environment allows the auditors to determine what can go wrong to result in materially misstated financial statements. In areas where the risk of material misstatement is high, the auditors must plan and perform more extensive audit procedures. Such procedures may be tests of controls or procedures to substantiate financial statement amounts. Internal control provides assurance that the client's records are reliable. When the auditors find effective internal control, the quality of other evidence required to substantiate the financial statement amounts is much less than if controls are weak. Thus, the auditor's assessment of internal control has a substantial impact on the nature of the audit process. The third standard of fieldwork requires that the auditors gather sufficient appropriate evidence to have a basis for expressing an opinion on the financial statements. The term appropriate refers to the quality of the evidence. Some forms of audit evidence are stronger and more persuasive than other forms. The four reporting standards establish some specific directives for preparation of the auditor's report. The report must specifically state whether the financial statements are in conformity with generally accepted accounting principles. If generally accepted accounting principles have not been consistently applied, then the audit report should specify those circumstances. Financial statements prepared in accordance with generally accepted accounting principles not only include the four basic financial statements, they also include whatever disclosures are necessary according to generally accepted accounting principles, and also to keep the financial statements from being misleading. So the auditor's report, by definition, also assumes informative disclosures are adequate unless otherwise stated in the report. Finally, the report should clearly state the degree of responsibility being assumed by the auditors by expressing an opinion or stating that an opinion cannot be expressed. And if it cannot be expressed, then the reasons should be given therefor. The American Institute of Certified Public Accountants has issued a number of statements on auditing standards, otherwise known as SASs, which provide guidance in compliance with the 10 generally accepted auditing standards. The SASs are codified within the framework of the 10 generally accepted auditing standards, and they are the most authoritative references that auditors can utilize to resolve problems encountered during the audit of a non-public company. Of course, as previously mentioned, the PCAOB is responsible for issuing its own audit standards, and although they have adopted initially all of the SASs issued by the American Institute of CPAs, subsequent to 2003, they have begun issuing their own auditing standards, and as they do, those auditing standards will supersede some or all of the SASs previously adopted. When a CPA firm is conducting an audit of a government entity or conducting an audit subject to government auditing standards, then there are additional auditing standards issued by the American Institute of CPAs and also by the federal government. Auditors have a responsibility to plan and perform the audit to obtain reasonable assurance, not absolute assurance, about whether the financial statements are free of material misstatement. Reasonable assurance is achieved when audit risk, the risk that the auditor may unknowingly fail to appropriately modify the opinion on financial statements that are materially misstated, is at an appropriately low level. Let me repeat the definition of audit risk. That is the risk that the auditor may unknowingly fail to appropriately modify the opinion on financial statements that are materially misstated. Financial statements may be misstated due to various causes, including errors, fraud, and certain illegal acts. Auditing standards define errors as unintentional misstatements or omission of amounts or disclosures in the financial statements. Errors may involve mistakes in gathering or processing data, unreasonable accounting estimates arising from oversight or misinterpretation of facts, or mistakes in the application of generally accepted accounting principles. Fraud, as the term is used in SAS 99, Consideration of Fraud in a Financial Statement Audit, relates to intentional acts that cause a misstatement of the financial statements. Misstatements due to fraud may occur due to either fraudulent financial reporting or misappropriation of assets, which is also referred to as a defalcation. During the planning of an audit, the auditors are required to assess the risk of material misstatements, whether caused by error or fraud. An audit must provide for reasonable but not absolute assurance of detecting material misstatement of the financial statements. Providing absolute assurance is not possible because available audit evidence is often less than convincing or conclusive, and due to the characteristics of fraud. For example, fraud often includes collusion among management, employees, or third parties, and is concealed by falsifying documents, including forgery. An audit rarely involves authentication of documents, nor are auditors ordinarily experts in authentication. In addition, management has the ability to override controls which otherwise may appear to be effective. Even if possible, audits providing absolute assurance of detecting material misstatement of financial statements would be exorbitant in price. In any case, to provide reasonable assurance, the auditors must exercise due care in planning, performing, and evaluating the results of their audit procedures. This requires auditors to exercise professional skepticism. Professional skepticism involves having a questioning mind and a critical assessment of audit evidence throughout the audit process. Professional skepticism involves proving the assertions that management makes in the financial statements through corroboration to convincing evidential matter. Fraud, as the term is used in Statement on Auditing Standards number 99, Consideration of Fraud in a Financial Statement Audit, relates to intentional acts that cause a misstatement of the financial statements. Misstatements due to fraud may occur either due to fraudulent financial reporting or misappropriation of assets, sometimes also referred to as defalcation. As explained in SAS 54, an audit carried out in accordance with generally accepted auditing standards should be designed to provide reasonable assurance of detecting illegal acts having a material direct effect on the determination of financial statement amounts, the same responsibility the auditors have for material errors and fraud. An audit does not generally provide a basis for detecting violations of laws and regulations that have an indirect effect on financial statement amounts. Laws and regulations vary in relation to the client's financial statements. Certain laws have a direct effect on the financial statement amounts. For example, they require an accounting entry and are considered on every audit. An example is income tax law, which affects the amount of income tax expense in the financial statements of most clients. The auditor's responsibility for detecting violations of these laws is greater than their responsibility to detect illegal acts arising from laws that only indirectly affect the client's financial statements, such as violations of antitrust laws. Violations of these laws have an indirect effect in that, while they may ultimately result in fines or penalties at the point the financial statements are being issued, no liability exists. Disclosure, however, may be required. The end product of an audit of a business entity is a report expressing the auditor's opinion on the client's financial statements. The content of the auditor's report varies somewhat depending on whether it results from the audit of a non-public or public company. Let us first take a look at the standard report for a non-public company. The auditor's standard report on non-public companies consists of 3 paragraphs. The report is generally titled Independent Auditor's Report, and the report is generally addressed to the individuals or entity that engages the independent auditor to conduct the audit. That is typically the board of directors or an audit committee of the board of directors, and often ratified by the stockholders. So most audit reports are addressed to the board of directors and stockholders. As I mentioned earlier, the audit report does consist of 3 paragraphs. The first paragraph clarifies the responsibilities of management and the auditors and is referred to as the introductory paragraph. The second paragraph describes the nature of the audit and is called the scope paragraph, and the final paragraph, also called the opinion paragraph, is a concise statement of the auditor's opinion based on the audit. At the conclusion of the report, the audit firm signs the audit report. If it is a firm that is auditing the company or the entity, then the signature is the signature of the firm. If the audit is conducted by an individual CPA practitioner, then the individual CPA would sign his or her name to the report. Finally, the report is dated. The report would be dated as of the date that the audit is completed. The audit is completed when there is no further audit work left to be performed, including review of that audit work by the audit engagement partner. The end product of an audit of a business entity is a report expressing the auditor's opinion on the client's financial statements. The content of the auditor's report varies somewhat depending on whether it results from the audit of a non-public or a public company. We will first introduce the standard audit report for a non-public company. Then we will follow that with a discussion of a report on a public company. What you are seeing here is the introductory paragraph of the auditor's standard unqualified report. This paragraph clarifies the responsibilities of management and distinguishes those from the responsibilities of the auditors. This paragraph is referred to as the scope paragraph, and describes the nature of the audit. The final paragraph, also known as the opinion paragraph, is a concise statement of the auditor's opinion based on the audit. The auditor's report is addressed to the person or persons who retain the auditors. In the case of corporations, the selection of an auditing firm is usually made by the board of directors or the audit committee, and often ratified by the stockholders. In those instances, the audit report should be addressed to the board of directors and the stockholders. In addition to the standard unqualified report, the auditor may have reason to issue other types of reports. The standard audit report assumes a consistency in the application of accounting principles from year to year. In the case where an accounting principle, the application of an accounting principle has been changed, then the auditor would mention, using explanatory language, the change in the accounting principle and the impact that it has on the financial statements. There are other reasons to issue something other than an unqualified report, such as a qualified opinion, an adverse opinion, or a disclaimer of an opinion. While these are rare, they do happen. Qualified opinions occur when the auditor's scope has been limited, or there's been a departure from GAAP which has a material effect on the financial statements. An adverse opinion would be issued by an auditor when there's been a departure from GAAP so significant that a financial statement as a whole would be misleading. And then a disclaimer of an opinion would be issued by an auditor when the scope of the audit has been so severely limited that it would not be possible to do a majority of the audit procedures required in order to conduct an audit in accordance with generally accepted auditing standards. Certainly, again, these reports other than unqualified are rare. In some cases, the Securities and Exchange Commission will not accept certain forms of report. For instance, they would not accept a report that was qualified for a scope limitation because the assumption is that that scope limitation could be removed. They also will not accept reports that are qualified due to departures from GAAP or an adverse opinion because of a pervasive departure from GAAP significant to the financial statements as a whole. Again, their logic is that a departure from GAAP can be remedied, and GAAP can be applied in every situation. So it would be a rare instance when a departure from GAAP or an adverse opinion because of pervasive departure from GAAP has been issued by an audit firm. As we previously discussed, the Sarbanes-Oxley Act requires that auditors of publicly traded companies perform an integrated audit that includes providing assurance on both the financial statements and the effectiveness of internal control over financial reporting. In these audits, the auditors may issue separate reports on the financial statements and internal control or issue a combined report. In a report issued by a registered public accounting firm on the financial statements of a public company, the title is different. Instead of a report of independent auditor, the title is now Report of Registered Independent Public Accounting. The report also refers to standards of the PCAOB rather than generally accepted auditing standards. And the report typically includes a fourth paragraph that refers to the report on internal control. And finally, the city and state of the audit firm that conducted the audit must be included. So firms that have multiple offices would indicate the city and state of the actual office of the audit firm that was the principal auditing office for that company's financial statements. Now we will move on briefly to AICPA attestation standards. You'll notice in Figure 2.5 in your textbook that the AICPA attestation standards are listed. You'll notice some similarities to the generally accepted auditing standards that we looked at earlier. There are a few differences. The attestation standards apply to a variety of other services that public accounting firms offer. In these types of services, the public accounting firm is offering some form of assurance on a variety of other assertions made by managements of entities. You'll notice in the chart in Figure 2.6 a number of those types of services that the public accounting firm may offer. The attestation standards are clarified in more detail in statements that have been issued by the American Institute of CPAs called Standards for Attestation Services. CPA firms may offer a variety of compilation, review, or even audit services related to financial forecast and projections, pro forma financial information, internal control, compliance with laws, regulations, and contracts, management's discussion and analysis of financial statements, and other reports known as agreed-upon procedures reports. The AICPA has issued statements on quality control that apply to auditing, other attestation, and accounting services for which professional standards have been established. Quality controls applied by accounting firms that provide these services will vary based on the size of the firm. Thus, the quality control procedures employed by a 200-office international firm will differ considerably from those employed by a single-office firm that audits only small businesses. All quality control aspects start with leadership. Leadership at the top of any firm has to set the tone for appropriate quality control. Following leadership, quality control standards usually fall into 5 other subheadings as follows. As previously described, the Public Company Accounting Oversight Board was established in 2002 with the following functions. The Public Accounting Oversight Board is composed of 5 members, only 2 of which are CPAs, selected from among prominent individuals who have demonstrated a commitment to the interest of investors and the public and an understanding of the issues faced by the PCAOB. Members are appointed by the Securities and Exchange Commission and may serve no more than 2 5-year terms. All accounting firms that audit SEC registrants must register with the PCAOB. As part of that registration process, each firm pledges to cooperate with any inquiry made by the PCAOB. The PCAOB may impose monetary damages and may suspend firms and accountants from working on engagements for publicly traded companies. It may also make referrals to the Justice Department to consider criminal cases. The PCAOB employs hundreds of administrative and professional staff. Many of the professional staff are individuals who came out of public accounting, including partners of public accounting firms, and also individuals who came out of the Securities and Exchange Commission and the U.S. Government Accounting Organization. The PCAOB staff perform inspections of the public audit practices of registered public accounting firms for compliance with the Sarbanes-Oxley Act, PCAOB and SEC requirements, and professional standards. CPA firms that audit more than 100 public companies are inspected annually, and firms that audit 100 or fewer companies are audited at least once every 3 years. Members of the AICPA who are in public practice and have financial reporting responsibilities must have a sample of their work reviewed by an independent party. To meet this requirement, CPA firms undergo a peer review performed directly by a CPA firm, or a team of CPAs. Public accounting firms that audit non-public companies, which would include not-for-profit entities, state and local government entities, privately owned businesses, partnerships, trust, foundations, and the like, are required to have peer reviews sanctioned by the AICPA. A peer review is performed of a firm's quality control system over audits and a sample of a firm's audit engagements. The peer review would be performed by another CPA firm with expertise in auditing, selected by the CPA firm to be reviewed, but approved by the AICPA as a firm qualified to conduct peer reviews. The peer review firm, of course, would be independent of the firm being reviewed. CPA firms that are registered with the Public Company Accounting Oversight Board are subject to periodic reviews or inspections by the PCAOB. These inspections are conducted by examiners employed by the PCAOB, and their focus is primarily evaluating performance of a sample of individual audit and review engagements and selected quality control issues. Upon conclusion of such an inspection, there is a written report issued to the SEC, part of which is made public.